Are you feeling ignorant about your own hotel's financial well-being? Would you be able to detect danger signs in the financial health of your hotel? Were you aware that picking up these danger signs in your hotel's financial well-being is a critical skill for a hotel manager, and it is guaranteed to get you elevations and promotions, ultimately success. However, most hotel managers have no understanding of the financial health of their hotel. Ability to detect early warning signs is actually a leadership strength. But most hotel managers tend to ignore this critical leadership strength. Because of that, their promotion and elevation opportunities become limited by their own actions. I will show you how you can easily identify early warning signs of your hotel's financial health. You would want that, right? And we'll be using a very simple technique. However, your peers would not know about this, so you will have a head start on them. And this technique will boost your chances for promotions, elevations, and all kinds of opportunities. Now, you may have a question, why me? I spent 26 years in the hotel industry in senior finance and leadership roles. I have myself detected hundreds of early warning indicators. Moreover, I have personally shared this with hotel managers and got them to identify them too. And that led to successful analysis and successful financial decisions. What if you were able to get a prior warning about the business performance? Wouldn't that be great? Particularly if it's something to do with your cash resources. Why is cash so important? Well, hotel needs to run its daily operation with cash. Liquidity ratios are those early warning signals that I talked about, the prior warning that you're getting. But what are these liquidity ratios? Let's find out. And before that, let's see what liquidity itself is as a concept. Liquidity simply means how quickly an asset can turn into cash. And now you can understand the cash resource importance. A hotel needs cash, obviously, to run its operation. And current assets of a hotel provide that much needed liquidity. But what are current assets, first of all? Let's take a look at the balance sheet of Paradise Hotel. Current assets form part of the balance sheet, and current assets provide cash resources. Hence, current assets end up providing liquidity. Current assets can include cash, short-term investments, accounts receivable, inventories, all of which we are going to see shortly. Let's first find out about the first type of liquidity ratio, the current ratio. The current ratio is the one most commonly used in hotels. It takes into account the current assets and current liabilities of a hotel, both of which we are going to see shortly. So as you can see, the highlighted total current assets and the total current liabilities. Let's now see what's the formula for a current ratio. We will be using the 31 December 2019 number for the current ratio calculations in the formula. The formula goes as current assets divided by current liabilities, and that means the numbers 338,000 divided by 214,000 equals 1.58. But what does a current ratio of 1.58 actually mean? Well, it means that your current assets are 58% higher than your current liabilities. Or in other words, you have a cushion of 58% between your current assets and current liabilities, which is a good thing. Now, current assets generally are used to pay off the current liabilities. And how do you do that? Well, this is by collecting accounts receivable, selling inventories. We're going to see all of which in a later part of this video. And also notice current assets includes cash, which is of course the main resource that is used to pay off current liabilities. Now, Paradise Hotel has a current ratio of 1.58. What is an ideal current ratio? Well, it's generally considered that a ratio of 2.0 is good, or current assets should be twice that of current liabilities. So Paradise Hotel is not too badly placed. Let's get back to that ratio now. You could state it as Paradise Hotel has 1.58 times the current assets needed to sell its current liabilities. So current assets of Paradise Hotel are pretty good. You could say they are pretty liquid. But are all Paradise Hotel current assets equally liquid? Let's find out. Each current asset actually has a different liquidity level. Cash, of course, is the most liquid current asset. An important fact to note about current assets and their placement in the hotel balance sheet. Current assets are placed in order of liquidity. That means the most liquid asset first, and then the second most, and so on. And that's why you notice that the cash is listed first. Let's see Paradise Hotel's other assets liquidity. Short-term investments are second in line after cash. These are actually money invested outside the company to earn income, and short-term generally means within one financial year. Next, the current asset accounts receivable is one of the most critical of current assets for a particular hotel. Accounts receivable are therefore third in liquidity. What are accounts receivable? Accounts receivable simply are sales made but money not collected. Accounts receivable have to be managed well so that the cash flow is positive. Let us analyze this accounts receivable for the Paradise Hotel in a little more depth. We'll be using AR as an acronym for accounts receivable. Notice the AR balances as below. On 31st/12/2019, its balance is 140,000. The previous year, 31st December 2018, it used to be 90,000. So, in a way, AR balances have increased 2019 versus 18. What's the net effect of this increase in AR? Well, cash flow decreases. Why? Because you have collected less. And so, an increase in an accounts receivable is a negative effect on cash flow. That's a warning. You could call it an early warning signal for accounts receivable. Remember, we are talking about hotel financial ratios, which are early warning systems, right? So it shows that it's not being managed very well. Now, what is the deal with the accounts receivable? Generally, the credit department is responsible for collections, and so it's responsible for also managing accounts receivable. AR balances generally should not increase year to year. This is because when an AR balance increases, collection decreases. And when collection decreases, cash flow decreases too. This means you have less cash resources to pay off your current liabilities. The next current asset, inventories, are equally critical. Inventories are fourth in liquidity. And what are inventories? Well, they are goods purchased, not yet sold or consumed. Inventories also need to be managed so that cash flow is preserved. Let us do the same analysis for inventories as we did for accounts receivable. Inventory balances are as follows. 31st December 2019, 15,000. 31st December 2018, 17,000. So inventories have actually decreased as opposed to accounts receivable, which increased, if you remember. Now, the net effect of a decrease in inventories is that cash flow increases. Cash flow is made better. This is a good sign that inventories are managed well. Let us address an important question while we are talking about the current ratio. Why are accounts receivable shown ahead of inventories? Well, accounts receivable is sales made, money not collected, while inventories are not sold at all. So liquidity-wise, accounts receivable is on a higher level than inventories. Inventories are actually considered the least liquid of current assets. Because they're considered the least liquid of current assets, a related ratio called quick or acid test ratio is also calculated. And what does it do? Well, it simply removes inventories from current assets or from the current ratio. And so the formula is current assets less inventories divided by current liabilities. So the current liabilities remain the same as for the current ratio. Quick ratio or the acid test ratio gives you a more accurate reflection of liquidity. The next current asset are prepaid expenses. These are quite common for any hotel. They are the last year in liquidity. They are generally payments made in advance for goods purchased or services rendered. Prepaid expenses also need to be managed so that cash flow is preserved. Let us now take a step back and understand what current liabilities are, which we used in our current ratio by dividing current assets by current liabilities. Notice the current liabilities as below. It's 214,000 in the year 2019, and it's 192,200 in 2018. So current liabilities have also increased. That means you have to pay more current liabilities in 2019 than in the previous year. But the current ratio of 1.58 for Paradise Hotel is reasonably good. And why is that? Because as you can see, the comparison between current assets and current liabilities over the 2 years, 2019 and 2018, the 1.58 current ratio is contributed by higher increase in current assets than current liabilities. That is always a good situation. Now, let's look at what's included in current liabilities. Accounts payable, as you can see, these are the balances for the 2 years. And here, what are accounts payable? Well, accounts payable are what the Paradise Hotel owes its suppliers. Generally, suppliers allow 30 days for payment. Because accounts payable have increased, more current liabilities need to be paid off in 2019. Next comes accrued income taxes, whose balances are as follows. Accrued income taxes are simply monies owed to the Inland Revenue Service for income tax. And accrued expenses, which follows accrued income tax, is similar, although they are estimated expenses payable by Paradise Hotel. Let's now look at the last item in current liabilities, which is kind of unique. It's the current portion of long-term debt, and these are the balances. Well, current portion of long-term debt is simply what is owed by Paradise Hotel within the next 12 months out of the total mortgage loan. So the current portion has increased. This means that either an installment is not being paid, which is not a good thing. Always compare your total current assets over 2 years with total current liabilities. Ensure current assets are close to the 2 times current liabilities. Ensure current liabilities are not increasing over 2 years. Let's now summarize our understanding of current ratio. So the first one is about the fact that current assets are divided by current liabilities to get current ratio. And current ratio of 2.0 is considered good. And quick ratio removes inventories from current assets and makes a more accurate reflection of liquidity. Do you want to learn more about the power of hotel financial ratios as early warning systems? Well, click on the video above on Ultimate Guide on Hotel Financial Ratios.